The stock market is a riddle to most. Millions of people risk their capital on what they believe is a matter of chance or privileged information, only to meet with consistent failure. But in the late 19th and early 20th centuries, one man dedicated his life to transforming this riddle into a readable science. He conducted a deep and intimate study within the very heart of Wall Street, and through decades of persistent observation and practice, he found that the market has a language of its own. To those who can read it, it tells its own future story. His name was Richard D. Wyckoff, and this is the story of how he learned to read it, and in turn taught others to do the same. His journey began not in a university, but in the real arena of finance, where theory gives way to harsh reality. In 1888, at the young age of 15, Richard Wyckoff started his career on Wall Street as a stock runner for a small brokerage firm. The world he entered was a cauldron of raw, untamed capitalism. It was an era of financial titans whose names alone could sway markets, men like J.P. Morgan, James R. Keene, and E.H. Harriman. It was also an era of profound danger for the common man, a landscape rife with manipulative stock pools, treacherous bucket shops designed to fleece the unwary, and a near total absence of the transparency and regulation that are commonplace today. This environment, perilous and electric, became Wyckoff's classroom. From his position, he had an unfiltered view of the actions of every class of market participant, and he was, above all else, a persistent student of the security markets. What Wyckoff witnessed day after day was a grand and recurring tragedy of financial self-destruction. This tragedy was not born of malice, but of a few simple yet devastating flaws in human nature when confronted with the allure of easy money. He observed that the majority of people who came to the street were almost totally ignorant of the business they were venturing into. They were, as he later described it, mentally lazy. A man who was otherwise shrewd, careful, and successful in his own established business would arrive in the financial district and promptly abandon all caution. His desire was not to learn the intricate machinery of the market, but to be given a tip, to be told something good to buy. This approach, he quickly realized, was not speculation. It was pure gambling. True speculation, as he learned to define it, involves the use of intelligent foresight. Yet most people he saw used neither. They were driven by two primal emotions, the hope of profit and the fear of loss, causing them to drift aimlessly in the market's powerful currents. A ruinous habit, he observed, was their tendency to accept a small profit with nervous excitement, while simultaneously tolerating a large and growing loss with stubborn hope. This single pattern of behavior was so common and so destructive that it formed the very business model of the bucket shops that littered the financial landscape. These early stock observations solidified in Wyckoff's mind the fundamental problem he needed to solve. If the path of the average man, guided by emotion and ignorance, led invariably to ruin, then the path to success must be its polar opposite. Success required a method, a set of logical, repeatable principles to replace the chaos of hope and fear. It required a science for navigating the market. Wyckoff's formal education in this new science began at the suggestion of his first employer, who encouraged the young man to begin studying railroad and other corporation statistics. He dedicated his nights to this pursuit, diligently poring over financial papers and studying the probable future value of various securities. When he lacked the funds for an actual purchase, he made imaginary trades, recording his selections in a notebook and, most importantly, the reasons for his decisions. He would later champion this method of study, advocating for years of paper trading before an individual should risk a single dollar of real money. He practiced what he preached. He did not make his first real investment until he had been studying for 8 years, and he did not begin active trading for another 6 years after that. He was building a foundation of knowledge that he knew would be invaluable. His first foray into the market was the purchase of a single share of St. Louis and San Francisco common stock at $4 per share. As he slowly accumulated more capital, he bought more one-share lots, a practice he continued until his chosen brokerage firm, annoyed by the small commissions, informed him they no longer desired his business. This forced him to buy larger quantities of fewer stocks, but his early experience with odd lots taught him a crucial lesson. He found that even when his fundamental analysis of a company's financial health and earning power was perfectly correct, the stock's price would often fluctuate widely due to external forces. A stock with excellent prospects might decline simply because the general market was weak. From this, he concluded that three primary factors governed a stock's movement: its intrinsic value and earning power, the manipulative forces acting upon it, and the overwhelming trend of the market itself. This realization marked a pivotal shift in his focus. He understood that to succeed, he had to look beyond the balance sheet of a single company and begin to analyze the behavior of the entire market and, most importantly, the powerful men who moved it. To truly understand these forces, Wyckoff knew he had to get closer to the heart of the machine. He secured a position with a leading New York stock exchange house that handled a large volume of business for the most prominent operators of the era. There, he began to analyze the market not from the perspective of an outsider, but from the standpoint of an insider who was a factor in influencing prices. These prominent operators were the financial titans of their day, men who commanded enough capital to operate the price of a stock through massive coordinated campaigns of buying and selling. He studied their methods with the intensity of a scientist observing a new phenomenon. One of these men was James R. Keene, a brilliant and feared operator who dominated the street. Wyckoff observed Keene trading over his ticker and saw firsthand the immense concentration and nervous energy required, even for a master. Keene's admission that he was doing well if he was right 6 times out of 10 taught Wyckoff a valuable lesson about the fallibility of even the greatest traders and the necessity of managing losses. Another was E.H. Harriman, the legendary railroad magnate who had built an empire through brilliant financial and operational maneuvering. Wyckoff learned from Harriman the importance of foresight, of seeing the hidden value in assets that others had discarded. Crucially, Harriman, who began his own career as a floor trader, advocated for the absolute limitation of risk, a principle that became a cornerstone of Wyckoff's own methodology. The most dominant figure of all was J.P. Morgan, the powerful banker who acted as America's de facto central banker before the creation of the Federal Reserve. Morgan's ability to foresee and orchestrate vast changes in the financial and industrial landscape was unparalleled. His formation of massive corporations like U.S. Steel demonstrated the immense power of organized capital to shape the market. Wyckoff also studied the methods of Jesse Livermore, perhaps the most famous speculator of the 20th century. Livermore's genius lay in his highly disciplined approach. He described to Wyckoff his core principles. Unless a stock showed him a profit within a few days, he would close the trade, reasoning that his timing was wrong and his capital could be better employed elsewhere. He would not allow hope to influence his decisions. He used both a price stop to limit his monetary loss and a time stop to prevent his capital from becoming stagnant. And as we hear these names and stories from a century ago, it's natural to feel a gap between that world and ours. How can we truly grasp these lessons without understanding the context in which they were learned? This is precisely the bridge that Max Davidson's unique new edition of Richard Wyckoff's masterpiece, How I Trade and Invest in Stocks and Bonds, was created to build. This is not just a reprint. It is a guided tour through the mind of a Wall Street legend, meticulously adapted for the 21st century trader. The original text has been updated to make the language modern and clear, but the real treasure lies in over 50 in-depth annotations. These notes explain the crucial context behind the names you've just heard, the inner workings of the bucket shops, the true power of magnates like J.P. Morgan, and the specific market conditions behind Wyckoff's most famous trades. It transforms a historical document into a practical, actionable playbook. For anyone who wants to truly internalize the lessons we are discussing, this annotated edition is an essential volume for your library. The link to get it is in the description below. With this deeper context in mind, we can better appreciate what Wyckoff discerned by observing these masters. He saw a common pattern. Their success was not based on guesswork or random tips, but on a deep understanding of market mechanics, supply and demand, and mass psychology. They did not follow the crowd. They anticipated the crowd's predictable emotional behavior and used it to their advantage. They planned their campaigns meticulously. First, they would quietly accumulate a large line of stock at low prices, a process that could take weeks or months, preferring to buy when the market was dull and depressed. This phase was designed to acquire shares without advancing the price. Once their accumulation was complete, they would begin the markup phase. They would advertise the stock on the tape by making it active and strong, generating excitement and attracting public buying. This activity, often accompanied by bullish rumors and news, would drive the price higher. Finally, at the peak of the public's excitement, when the news was universally positive, they would begin the distribution phase, selling their large holdings to the very public they had lured in. This transfer of stock from strong, informed hands to weak, uninformed hands left the stock in a technically precarious position, ready for a decline. Wyckoff's objective became crystal clear. He had to decode these campaigns. He had to learn to spot the thumbprints on the tape left by these large operators, so that he could follow them with pleasure and profit. This intense focus on the market's own actions led Wyckoff to the stock ticker tape, the primary source of real-time price and volume data in his era. He began to see that the tape was far more than a simple record of transactions. It was a running commentary on the balance of power between buyers and sellers. He realized that the basic law of supply and demand governed all price changes, and that the best indicator of the future course of the market was the relationship between this supply and demand. He saw that the action of stocks reflected the plans and purposes of those who dominated them, and that by studying the tape it was possible to judge what these masterminds were doing. Every transaction, he reasoned, represented a meeting of minds. By analyzing not just the price but the volume of shares traded, one could measure the force of the buying power or selling power, the eagerness of the buyers and the anxiety of the sellers. The tape, in essence, was a record of market psychology in motion. It told the news minutes, hours, and sometimes days before the newspapers. Everything from a corporate development to a Supreme Court decision was reflected first upon the tape, as those with advanced knowledge made their moves. These studies were first codified in his influential book, Studies in Tape Reading, a work that laid out one of the first systematic approaches to technical analysis. Initially, he used these principles for active, day-to-day trading. However, he soon found that the same principles could be applied with even greater success and far less nervous strain to the intermediate swings of the market. Those movements of 5, 10, or 20 points that typically unfold over several weeks or months. It was in these larger swings that the campaigns of accumulation and distribution were most clearly defined and offered the greatest opportunities. To simplify the complexities of the market, Wyckoff developed his central interpretive concept, the Composite Man. He urged his students to cease thinking about the market as a chaotic collection of thousands of individual traders, and instead to view its action as the expression of a single mind. "Let us call him the Composite Man," he wrote, "who, in theory, sits behind the scenes and manipulates the stocks to your disadvantage if you do not understand the game as he plays it, and to your great profit if you do understand it. This Composite Man represents the amalgamation of all the shrewdest, most well-informed operators and financial interests. He is the epitome of smart money. He is cool, calculating, and patient. His purpose is to conduct well-planned campaigns to accumulate stocks at low prices and then distribute them at high prices. He advertises his stocks on the tape by making them active and strong to attract a public following when he wishes to sell. He makes the stock look weak and triggers raids to frighten the public into selling when he wishes to buy. The Wyckoff student's job is not to fight the Composite Man, but to recognize his operations as they unfold on the charts and on the tape, and to take a position in harmony with him. By studying the market as if it were the result of one man's operations, the entire process of analysis becomes vastly simplified. One no longer asks, "What are thousands of people thinking?" but rather, "What is the Composite Man doing now? Is he accumulating, or is he distributing?" This single powerful concept cuts through the noise and confusion of the market, allowing the analyst to focus on the true story of supply and demand. As Wyckoff's understanding deepened and his own success grew, his focus shifted increasingly toward education. He felt a strong responsibility to share the principles he had uncovered. This mission led him, in the midst of the panic of 1907, to found a magazine called The Ticker, which he later renamed the Magazine of Wall Street. He had two primary motivations. First, he found that the process of writing out his thoughts helped him to clarify and crystallize the principles that guided his own operations. Second, and more importantly, he aimed to demystify the market for the public. He had seen firsthand that the public's greatest handicap was its ignorance of the real rules of the game. He wanted to emphasize that success on Wall Street was not a matter of luck or mysterious connections, but of common sense combined with dedicated study and practical experience. His magazine quickly became a hub for those seeking a deeper understanding of the market. He received countless inquiries from anxious investors, and he examined numerous trading ideas and mechanical systems sent to him by subscribers. This process of teaching and interacting with others further honed his own methods. He saw that most clients wanted to lean, not to learn. He believed that the only way for a broker to build a base of permanent, successful clients was to educate them, to teach them how to make their own sound decisions. This philosophy was radical for its time, but it was the core of his life's work. His ultimate goal was to provide investors and traders with the tools for self-reliance, to help them graduate from the class of the uninformed public to the ranks of shrewd, independent operators. This lifetime of observation, practice, and teaching culminated in the formulation of the Wyckoff Method. It is not a rigid mechanical system, but rather a school of thought, a logical framework for market analysis based on judging the market by its own action. The method is founded upon three fundamental laws that govern all price movement. The first and most essential is the law of supply and demand. This is the axiom upon which everything else is built. When buying demand is greater than selling supply, prices must advance. When supply overcomes demand, prices must decline. When the two forces are in equilibrium, prices move sideways in a trading range. The tape reader's and chartist's entire purpose is to gauge the present and future relationship between these two forces. The second is the law of cause and effect. This law states that for every effect of price movement, there must be a preceding cause. The cause is the process of accumulation or distribution within a trading range. The effect is the subsequent markup or markdown. The extent of the effect, or the size of the price swing, is often in proportion to the extent of the cause. A long period of accumulation, therefore, builds a cause for a significant advance. By analyzing the duration and intensity of trading within this cause-building area, one can often project the probable extent of the coming move. This transforms speculation from a mere guess into a logical deduction based on the evidence of preparation. The third is the law of effort versus result. Here, effort is represented by the volume of trading, while the result is the price movement that follows. Harmony between effort and result confirms the trend. For instance, if trading volume expands significantly on an advance and the price moves up sharply, the result is in harmony with the effort, and a continuation of the advance can be expected. However, a divergence between effort and result is a critical warning sign of a potential change in trend. If volume is very high, great effort, but the price makes little or no upward progress, poor result, it indicates that a large supply of stock is meeting the demand and halting the advance. This is often a clear signal that a turning point is near. Conversely, if volume diminishes significantly during a decline and the price stops falling, It shows that the selling pressure effort is drying up, and a rally may be imminent. The practical application of these three laws is found in the analysis of the four-phased market cycle: accumulation, markup, distribution, and markdown. During the accumulation phase, the composite man is quietly buying a stock that others are ignoring or selling. This often occurs after a significant decline and is characterized on a chart by a trading range where volume tends to diminish on reactions, indicating that selling pressure is being exhausted. Once the informed interests have acquired their desired line of stock, the markup phase begins. The price is actively pushed upward, attracting public buying and often aided by the timed release of bullish news. As the advance continues and public excitement reaches its peak, the stock enters the distribution phase. Here, the composite man begins to sell the shares he accumulated at lower prices to the enthusiastic but uninformed public. This phase is often marked by heavy volume without significant further upward progress, a clear sign of effort without result, as large supply absorbs the frenzied demand. Once the stock has been transferred from strong hands to weak hands, it is technically vulnerable, and the markdown phase follows. This is the path of least resistance, downward. The public, having bought near the top, is forced to sell in a panic, adding to the selling pressure and accelerating the decline. This cycle repeats itself constantly, in all time frames. The Wyckoff student's primary task is to use charts, both vertical line charts for price and volume, and figure charts for measuring cause. Not as mechanical predictors, but as visual tools to identify which phase the market is in, and to align his actions with the composite man. Wyckoff's ultimate goal was never to create a legion of disciples who would blindly follow his personal judgment. On the contrary, his entire philosophy was built upon the principle of self-reliance. He consistently maintained that it is better to depend on one's own judgment than on that of any other person. The money that does the most good, he believed, is the money made through one's own efforts. Therefore, his true legacy is not a list of famous followers, but the method itself, a logical, teachable framework that empowers the individual. He was one of the first to take the chaotic art of tape reading and transform it into a structured science. His real successors are the thousands of students and readers who have used his principles to move from the ranks of the uninformed public, who are generally wrong, to the class of astute, independent operators who think for themselves. This requires diligent work. He often lamented that people succeed in business because they study their mistakes, yet few apply this same rule to their trading. The study of the market is a serious undertaking, a business that requires training, capital, and courage. The principles he laid down are not a guaranteed formula for riches, for no such thing exists. They are a guide to understanding, a way to substitute knowledge for gambling, and a means to cultivate the foresight that is the very essence of successful speculation. The market will always be a challenge, a test of one's judgment and self-control. But it is not an indecipherable mystery. It speaks a language, and the purpose of Richard Wyckoff's life's work was to give every persistent student the tools to understand it.